And then who else are we waiting for? Tony's jumping on now. And is Mary Kate joining?
I didn't receive a response, no.
Okay.
I think Dr. Cook.
Yeah, she had shared, Max. She's not
Okay.
able to attend tonight. Yep.
Okay.
So you're a quorum of one.
Yeah, we got to work on that. Actually, me leading all these committees, but anyways, we'll get to that later. So good evening, everyone. So why don't we just jump right in? So if you can actually show the, I think we lost the who's sharing the screen. I just lost the screen.
Mike is sharing the screen.
I can share the screen? Okay. I can't see, all I can see is your lovely faces.
Oh, do you want me to, are you ready to share my screen? Is that what you're saying? Sorry, I missed that.
Yeah. Who's sharing the screen now? I thought someone was just sharing. I don't see a share at all anymore.
Keith, you want to just put the agenda up real quick for Mac, and then Mike, we can dip into it.
Well, why don't we just, here we go. Fine. All right. So I guess we'll go through the formality, call the meeting to order. And so, and if we could please take the roll.
Yes, Max starts.
Yes, here, thank you.
Okay, thank you.
Great, so I want we then jump right in with the fiduciary governance calendar.
Okay, I'll take over here. Everyone see that okay?
Yes.
Okay, so this quarter, the focus is on governance itself. So this is typically where we give a review of the investment policy statement, provide some best practices from a committee standpoint. I'll tell you that there's not a lot to do here. We put together this checklist for you. You'll see all the key items are checked off. We have reviewed the policy. It's still as of kind of the original policy wrote as of 2014. We're still not recommending any changes. We kind of reviewed it back in 2018 and made a couple modest adjustments, which have been finalized. We think it's still in good shape to this point. There's a couple X's on here, but they're not really required in this circumstance, because neither pool is a true endowment. It's not going to have a set spending policy, so there's no reason to have that in the policy statement. Because we run a very liquid pool with no private capital or liquid exposures, we don't really need those guidelines. And the proxy voting, because this is all mutual funds, is covered by the mutual fund documents itself and not within a policy statement. So everything else is lined up. I would say, and this probably should have been a green check, so I'll check with the team on that, but we do have some ESG policy in here, high-level ESG policy that we added back in 2018, which is actually, and then we provided the document here as well. So we won't read through each one of these, but it's always a good practice for everyone involved just to refamiliarize yourselves with the policy statement, at least on an annual basis. So we provided it here in the deck so you can do that. Again, I won't read through each one of these, but continue to operate the portfolios in line with the investment objectives and the policy guidelines as outlined here. From a committee best practice, again, I won't lead all of these. These are generally just things we'd like to see groups doing from a good governance standpoint in terms of structure, makeup of the committee, how that committee operates, and how it's documented. I'd say, Mac, kind of you noted that potentially expanding the membership a little bit would maybe be the one thing that we'd encourage you to think about and can help you think through. But in terms of structure of the meetings, the governance process, and how it's all being documented, certainly checking the box there from all regards. So I'd say no major concerns here as well. And then the last thing we'd say is in for the document I sent you, these are actually all links. So we've been putting a lot of material up for client consumption on the website. We send a lot of blast emails out. Some of it's very pertinent, some not so much, but we'd encourage everyone, as you're kind of flipping through things or thinking about implications to take a look. We do have a pretty good podcast going with Bob DeMeo, who's our CEO, and Devin Francis is one of my partners on the endowment team, has a bi-weekly podcast that's specific to nonprofits. So they'll have things pointed to higher education, spending policy, a whole host of things impacting colleges and universities today, et cetera. So there's some pretty good stuff on there if you ever get a chance to listen in, but really just kind of a plug to some of the content we put out. So I'll pause there and see if there's any questions on the governance materials.
No questions.
Okay. So from a market standpoint, we'll switch over to the portfolio. So as a reminder, this is through the third quarter, so September 30th. First quarter in quite some time where we saw capital markets take a bit of a pause. We started out the quarter okay. Things were kind of trending in that very positive line. September was a challenged month. I would tell you that October we've made up for all of September and then some. But the real drivers of that were some concerns over Fed guidance. So for the first time in a while, right, with some of these inflationary pressures we keep hearing about, the Fed kind of foreshadowing that at some point they're going to have to start to tighten up that really easy monetary policy that they've had us in for quite some time here since the pandemic, and really dating back to the financial crisis if you think through it. But winding down their bond buying program, starting to increase interest rates are certainly on the horizon, starting to give some guidance on that, which the market appreciates, but certainly coming off anything where it has been kind of this steady, really easy monetary policy type scenario, that did spook markets a little bit. You can see from a futures perspective, the expectation was for rates to start to spike up in 2023, but you can see that we're actually running kind of notably ahead. This is about 3 or 4 rate hikes by the end of 2023 is what the market is kind of expecting now. So certainly a pretty significant change from where we've been. On top of that, we all know that there's been a ton of gridlock in Washington across the whole host of factors, which, that leads to uncertainty in the markets, particularly with some of whether it's the stimulus efforts from a fiscal standpoint, its infrastructure package, some of the other policies that are out there that have a real focus on, clean energy and implications to industries out there. That gridlock has really spooked things as well. So that's been a bit of a pause. And then this kind of resurgence of COVID with the Delta variant also put a damper on things for the tail end of the summer, as we all know. So all those things kind of stacked on top of each other gave markets a little bit of a pause in the period. I'd say that from a positive standpoint, the financial health of consumers appears very strong, and they represent about 70% of the input of GDP. So that's a positive. You can see net worth is up dramatically. Debt service is down dramatically. So the consumer still looks pretty good, which should be a positive here. And one of the reasons we think that the markets will continue to be supported here in the near term, and why we really saw October kind of bounce back in a pretty strong way once we see those final prints. Year over year GDP, the second quarter number came in quite a bit lower than what was expected. So that was certainly a negative, but generally the trend has been on par with where we had expectations going into this year, and certainly for next year, which the market has appreciated. This inflation concern is something we continue to pay close attention to. It's been in the headlines, up obviously dramatically. We all see it day in and day out, whether you're going to the gas pump or the grocery store. We hear about supply chain disruptions, all the shipping vessels, just anchored off the coast of California. That seems to be on the news every night. So prices have come up. We're coming off very low base rates. So year over year, it looks pretty dramatic. We still think that this is more of a short-term trend, that it's more of a supply-demand imbalance that will work its way out. A lot of it driven by energy and food in particular. But we don't see anything that is one of the big structural shifts in terms of, sustained inflationary pressures on a go-forward basis. So we think it'll take us a little bit of time to work our way out of that, certainly paying attention to the longer term implications, but nothing that's like a stagflation environment or anything that brings us back to the 1970s or 80s or anything like that. Maybe something that hovers around that 2.5% to 3% range here, which is a lot closer to historical averages, been north of where we have been for the last decade, but really on historical averages, and shouldn't be something that the market isn't able to work its way through. And a lot of that has been driven by oil. If you remember back to at one point in 2019, right, we had negative prices for a couple hours on futures contracts for crude oil prices, WTI crude oil prices. Obviously, that has reverted dramatically, kind of up around $90 a barrel where we sit today, and a tremendous amount of concern about just supply and demand needs coming into the winter, both from a natural gas and an oil standpoint. So something to keep an eye on that has really shifted those oil prices up. And really, that's just one example of real assets, but really real assets have responded very favorably in this inflationary environment that we found ourselves in here the last couple of months. From an asset class standpoint, a reminder that the circles are for the quarter, the bars are year to date. So as I mentioned, pretty muted returns for the quarter. Fixed income rates were up modestly. So we had basically a flat return for core bonds. Spreads came in a little bit. They're at very tight levels, which I'll show you here in a minute. So not a whole lot of return to get from fixed income, as we really kind of have talked about for the last 2 years now. At these very low base rates, we expect very muted returns from fixed income, and we've certainly seen that. Although as spreads have tightened in, that's provided a little bit of a boost. On the equity side, U.S. large cap markets were flat. Small cap markets were down pretty meaningfully, about 4.5%. Foreign developed markets were modestly negative, essentially flat. And then emerging was really the big headwind. A lot of that was the result of China. If you remember China, there was a pretty big spook to the Chinese markets with some of the regulatory initiatives that the government unleashed in the quarter, sent the Chinese market actually into bear market territory. So it was down more than 20% at one point in that period. If you actually back out China, which is about 35% of the EM benchmark, the other 26 emerging market countries were actually positive 2%. So really a negative period for China, but not a whole lot of contagion across the rest of the emerging world. And then lastly, here's the real assets. So as I mentioned, really the bellwethers for the year, given they were off dramatically in 2020, they're very economically sensitive, as we know. So as that markets have recovered and we've seen those inflationary pressures, these really have driven returns pretty dramatically. REITs up 23%, commodities up close to 30% as a result of that. So really having this exposure in the portfolio, which we've had for some time, it's been a little bit of a headwind to that long-term pool, having that inflation hedge in here. But now that we've really seen it pay off as we start to see some of those pressures, and one of the reasons why we held it at a modest weight as a strategic allocation. On the fixed side, here's the yield curve. So we moved up from 145 to 153 basis points, although the curve was pretty volatile, really all over the place. Still very muted return expectations as a result of these very low levels. And you can see how much spreads have crept in, right? This was a great opportunity for fixed income managers to add spread exposure and credit management into their pools. Now you're really not being compensated a whole lot. We're essentially at historical lows, and kind of the level that you're being compensated to own high yield today, about 265 basis points of spread, is where you'd expect to see investment grade credit historically. So kind of taking the risk of junk bonds or high yield bonds to earn investment grade like spread, it's not a great environment to be investing in fixed income, both from a low yield standpoint and a risk management standpoint. On the equity side, we did see valuations subside a little bit, so they still look quite stretched, especially here in the US, although the earnings numbers have continued to be strong and move up, so that denominator has shifted upward. Foreign markets kind of back within one standard deviation of their mean. Emerging markets really back on their longer term averages as a result of earnings and those price numbers coming down pretty dramatically. And to my point on China, right, everything else has been pretty consistent. Korea had a little bit of contagion from the China news, but most global, kind of the major global economies in positive territory from a capital market perspective for the quarter and for the year, China being really the major outlier. And this, in contrast to that, places like Russia actually up close to 30%, very energy dependent in this period. So 50% of dispersion between two of the major emerging market countries has been made it a very interesting place for active managers to try to add value. So I'll pause there and just see if there's any questions. These are the broad capital market returns. I won't go through all of them. I would just say, low base rates, we continue to expect fixed income returns to be quite muted on a go-forward basis. We expect equity markets to be supported in the short term from stimulus efforts, from kind of positive trends in terms of where COVID is headed, some of the other factors we talked about, and just good corporate earnings. But the S&P now is annualized at close to 16.5% on a 10-year basis. That's about 700 basis points ahead of its long-term average, very long-term average. So at some point, we would expect that kind of the valuation levels and those pricing levels to catch up with itself in the mid to the long term, and something to pay close attention to from where we sit today. So I'll pause there and see if there's any questions on the markets, and then we'll jump into the portfolio specifically.
Mike, I had no questions from me, but just overall, I thought it was a really good overview. Particularly, you referencing the tough September we went through, but that was more than offset with a good positive October. So that was good to hear. Then also just your comments around inflation, right? Not thinking it's a long-term play, more of a short-term thing. So appreciate those comments, but good overall overview.
Okay, let's overlay that more importantly into the portfolio. So we, just to give you a sense of market value, so actually a lot went on in the portfolio this quarter, as we touched on last. So we started the quarter at about 19 million. You made that $10 million contribution into the pools in August, so that's reflected here. So we actually ended September just shy of $29 million across both pools. To give you a sense and a reminder of kind of what went in, so we received the deposit into the short-term pool. We had put together that place of a dollar cost averaging strategy to move about 5 million from the short-term pool into the long-term pool in $1 million chunks on a month-over-month basis. So the first million moved in August. We've since completed September, October, and just wrapped up the November move. We, in theory, have one more move to go. I know we're going to, there were some conversations last night at the board meeting, and I know John we had a conversation about this. I'm sure we'll touch on it in a minute, on if we keep that process going based on some of the projects in the future. So I'll leave it at that for the now, but that's where we stand today. We have moved about 4 million over from the short-term pool into the long-term pool with that process. And here's how we settled out. So long-term pool, about $16 million. In September. Given the cash flows, we've been able to use that as a rebalancing mechanism to get us pretty much spot on target. One of the big things that happened, if you remember, is we decided to make a move away from the Atos Capital Prime portfolio in the hedge fund space, convert that over to a group called Ironwood. That occurred in October. So we got the 930 value for September. That was paid out to us the last week of October. It was then reinvested into Ironwood on November 1st. So you'll see that reflected in the next flash report, but that has been completed. That was really the only change we made in the portfolio besides allocating those contributions as the money came in. For the quarter, the portfolio was modestly negative, down about 1%, a little bit behind the benchmark, mostly driven by the fixed income side, which we'll touch on. But on a year-to-date basis, still well ahead. And on a one-year basis, still well ahead as well. So not really kind of impacting some of those that strength that we've had in the last couple of discussions. I mentioned the fixed income side. Most of it, actually all of it, was driven by Brandywine, which is our global bond exposure. They do a lot in EM debt and currency trades as well. Given some of the issues in emerging markets, the debt side in particular got impacted with expectation for what U.S. rates were going to do. Some of their positions were dramatically out of favor. So a tough quarter for Brandywine, but you can see on a one-year basis, still up 5% while that benchmark is negative. So not overly concerned there. We expect quarters like this from Brandywine, just given how they invest the portfolio, given that they are pretty eclectic in some of the relative value trades that they have on. The domestic equity side held in well. Diamond Hill continues to perform very well, both relative to its value index and the S&P 500. Really top of its peer group again in the quarter. That's been the biggest driver of value. The two index funds right in line as we would expect. And then actually Boston Partners and Conestoga strong quarters as well, particularly Conestoga. They are more of a quality focused small cap growth manager. So they actually had looked quite weak through the tail end of 2020, beginning of 2021, since we've added them to the portfolio, where some of these high growth, highly speculative small cap growth names, particularly on the healthcare side, really led the way. As that market environment has shifted, you'll see Conestoga came back into favor here tremendously about 1,000 basis points ahead of its peer group or the benchmark in that period. So some really good stock selection given, and definitely some tailwind in terms of their style approach as well, but certainly a nice addition. And since we've added them, they've been very accretive to the pool as well. On the foreign side, a little bit behind. Dodge and Cox was the big headwind there, but again, not a big concern for us at this point. Schroders has performed well in the emerging world, as we've touched on in the past. And then from an alternative perspective, Atos actually kind of finished up for us in a nice way. Again, they're out of the portfolio, but generally in line here. So really all the little bit of dispersion across the board for the quarter, but the kind of year-to-date and one-year themes still remain in play. And most of the managers have been able to kind of work their way through this environment in a very positive fashion. So continue to be pretty happy with the postures and the results of the pool. But again, I'll pause there and just see if I can answer any specific questions of the managers or thoughts or whatever they may be.
I mean, the move on Atos, we talked about that, the last quarter, it makes sense. I mean, the performance of the others, are certainly in line with what we expect. I mean, it's hard to argue with these returns, right? I mean, so, from a question standpoint, it's we see you're actively managing the account. And from my perspective, that's most important. But in terms of the individual managers, seeing this performance, like I said, it's just hard to have any particular questions about kind of what the performance is. So good job so far.
Okay. There's no questions there. The only manager that we have on a different status and maintain is MetWest. We have that on discuss. That's just Tad Ravel, who's been their longtime CIO and kind of generalist portfolio manager, is going to be retiring at the end of the year. So they have a very deep team in place. This is by no means a one-man shop. It's one of the largest fixed income managers in the world. So they've had a succession plan in place. We're keeping a close eye on it. We did move it to discuss because it is a notable event, a CIO retiring. So we'll keep you posted on that, but not a major concern and no real concern that it's going to have an impact to the portfolio in general. From a short-term perspective, this portfolio is not quite as exciting as we all know, but still kind of continuing to plug along and meet our expectations. So just shy of 13 million at the end of September, right in line with target. Again, because we've been moving that capital over, we've used it as a mechanism to rebalance and keep us on target. From a return standpoint, flat for the quarter, really flat year to date, pretty muted returns across the board, but certainly doing better than money market, which is really what it's set up to do. If you look at the underlying pools, some of these peer group rankings don't mean a whole lot in terms of Vanguard or whatnot. They're generally plotting where we'd expect them to be. MMDT continues to do better than kind of traditional off-the-shelf money markets, which we expect them to do, given kind of its that's the plan that's only open to public state entities with so low fees and kind of a unique approach there that we're able to benefit from. The rest of the funds have held in there as well. The CREF fund, which gives us that ESG lean and a little bit more duration of the portfolio, has held up well relative to the ag as well. Kind of everything plugging along here from our perspective in the short-term pool. But very conservative, running at about 1.25 to 1.5 years of duration. So very little, certainly no correlation to what's going on in the equity markets, very low correlation to what's going on with interest rates, really just trying to clip some sort of yield from this where we can, but keep it very conservative. I would say, the one thing to keep in mind with this pool, because it will come into our conversation here in a minute, is that while it's being managed very conservatively, we're trying to maximize yield where we can. These types of returns, right, and what we expect to get from it on a go-forward basis are not likely to keep pace with inflation, right? If inflation is going to be in the 2.5, 3% range, earning 1 to 1.5 means that, we get some downside protection in this, but in terms of protecting purchasing power, which isn't necessarily the role of this pool, but it is just something to keep in mind in terms of stashing long-term money here that we are. And this could change over time, but currently likely eating into that value on a go-forward basis for the monies that do sit in this pool.
That's a great point. That's one of the things we talked about when we were considering options of moving money between short and long, but that's a fabulous point.
I mean, on that, Mike, I would just offer my one comment, right? So great support from our trustees last night via the Ways and Means Committee on our next major capital project, right? You heard perhaps from John Tudrin about $6 million as a real important down payment as part of that larger project. I wanted to link that into what you just talked about, because maybe there's a strategy, because we probably won't need that money, that $6 million at the very least for a year, perhaps maybe even 2 years, where we really sort of try to change what the position is short term, knowing we're going to pull it out 2 years. So really try to ramp up rate of return on that money with a different kind of window attached to it, because we know we're going to need to pull it out, not likely 3 years from now. So again, I wanted to connect those two for you for thinking and for some future consideration.
Yeah, and John and I had that conversation in preparation for this meeting about, thinking through that. And, a 2-year window is tough, right? If it was like, we need this money in 6 months, then it's like, it probably belongs there, right? 2 years and some still uncertainty about, how much do you need in the short-term pool? I guess by the old calculation, right, the answer is 0. I think from a comfort standpoint, the answer was, somewhere between 4 to 5 million. There's still a chance we might need it to backstop operations, in the next coming years, and what makes us comfortable there. And then kind of keeping that money in the long-term pool where, in theory, you should get a meaningful arbitrage opportunity in terms of return expectation, but where we sit in the market environment, very low interest rates and potentially moving up with inflation, and equity markets that have been on a 12-year bull run, it does give you a little bit of pause in terms of saying we want to maximize returns there. But so it's kind of that 2-year ground is challenging. I'd say on the most conservative side, you say, okay, we're going to put the money in the short term. We recognize that there's a chance, there's probably a good likelihood we're going to eat into the purchasing power of this a little bit, but we can sleep very well at night knowing that the Building 20 project is covered, that we have money there from the operating side if we need it, and then it lets the long-term pool continue to grow and kind of work its way out. In contrast to that, I don't know that I would put all 6 million of it in the long-term pool, but kind of keeping some there as we dollar cost average in, and then kind of think about dollar cost averaging out as you have a way to or get more clarity on what the operating side looks like next year. And if you really might need that 4 or 5 million, or if that can be used for the Building 20 project, then, making a decision one way or the other is tough around that circumstance. So those are kind of the two scenarios as I see it. I don't love the idea of kind of putting it all in the long-term pool and hoping we continue on this trend, but I certainly don't know, unless the board is very comfortable with it or really just kind of taking any risk off the table with that 6 million. I think some combination of both and kind of continue to leg our way in and then leg our way out as there's more clarity about when that money is needed is probably a nice way to go about it.
Yeah, thanks for that, Mike. So Dr. Cook, any thoughts around how we would actually use the timing of how we would use that 6 million? Like we wouldn't use all at once, right? But so might be early on that, but.
Yeah, I mean, Mike and for Mac too, right? He knows that DCAM is going to have to help sort of scope this, schedule this for us. So once we have a timetable, we're thinking very optimistically that we're going to get funded, and we'll have a better sense when we actually get in there and start doing design work, what have you. I'm saying this for Mike Chase, right? So I think that will help us, Mac, I think on the timing and the mapping piece. For me, Mike, you really have my attention in terms of the losing ground because of inflation. And, I would say, Mac, from the impetus with this approach to fund and investment, I think the trustees have always sort of sometimes erred a little more slightly on the side of conservatism and caution. I think that's always borne really well for us. Mm-hmm. So I don't want to, Mike Chase, I don't want to somehow seem to tamper with a strategy that has really worked well for us. Always taking the long view, But it's hard when we sort of have some of this knowledge right now, especially again, losing ground on inflation, to not just give a hard look to that. That's all. And again, I like your incremental piece. It's not go all in, seem to sort of try to gamble the 6 million, but there may be a way where you can get a little bit more ground gained as part of this, especially maybe into 2020 when we do put our budget together, when we have that trustee approved budget by next June, and we've got better clarity on how much propping up we might need there.
Well said.
So if I can just jump in, I know that John and Mike have talked through this, and you know, John's got a potential sort of proposal or a look at this if people are interested in taking a look at that at this point. You know, in terms of what that could look like over the next several months. Do you want to see?
Is that an ask? Was that going to be shared, or is that an ask to be shared?
It can be. John's prepared to share that right now. It'll take a few minutes.
Yeah, sure. We'll take a look at it.
Great. Thanks.
We have the time. What's else is on the agenda? This is pretty much.
I think this is it.
Yep. Okay.
Are you able to see that
Yes.
slide? Okay. So this is,
We just lost it, John.
I'm sorry?
We just lost it.
How about now?
That's coming back up now. Yep. We got it.
Okay, thank you. Okay, so this is along the lines of what Mike just outlined. This is the approach where we could potentially still earn a return without parking, you know, the full amount into short term and, you know, not following the most conservative route. So what this would show is that when we transferred $10 million previously, and we are splitting it between 5 million to short and 5 million to long, we talked about doing the dollar cost average approach. We have $1 million left to transfer, as Mike mentioned, which would be December. But we could continue that approach. We could continue to transfer $1 million in January, February, March, and onward. We don't need to make that decision right now as to when that would end. This particular graph shows that it would go through May. If we went through May, we would be left with approximately $5 million in the short-term account. Again, we hope to receive a response over the summer as to, you know, building 20 and the funding from DCAM. And at thereabouts that time, we could start to reverse and start to raise funds, transferring funds back from the long-term portfolio back to the short-term portfolio. And certainly, you know, this strategy would allow us to take advantage of any potential turns by investing funds into the long-term pool. What this chart shows on the left-hand side is just the blue line graph shows what the short-term portfolio is. So starting off with just shy of $11 million. And again, as we continue to transfer funds to the long-term pool each month, you can see how that balance goes down to approximately $5 million when we get into the May timeframe. Conversely, the long-term account increases, you know, close to $25 million at that same time frame. The gray line shows just the balance holding steady throughout that whole time frame. You know, no, it doesn't recognize any returns or losses that the market might reflect. So I guess the question that I would have, and I don't know if Mike, I can ask you to kind of just like jump in. If we went with an approach like this, and again, we can certainly revisit this at the next investment subcommittee meeting. If we wanted to follow this approach, we would still have at the next meeting somewhere in the vicinity of about $8 million in the short-term account. So still a healthy balance. Talking with Mike, I don't think we're recommending transferring funds between the short-term pool into the long-term pool any more aggressively than we have been. But one question that I would have is if the market does turn, if it's an unfavorable environment and we get to the point where we're in the April, May, June timeframe and we want to start raising funds, do you have a concern as to how we would do that if we had a lower balance in the short-term pool? If it was in the vicinity of 5 or 6 million, we know we need 6 for building 20. And if we need more for budget constraints or other operational needs, can you speak to that for just a minute?
Sure. So in the long-term pool, right, we still have a 25% target to fixed income. So if we grew that pool to 25 million, you take a quarter of that, right? That's still just over $6 million in fixed income. A good chunk of that is in kind of core, very conservative fixed income that in a choppy equity market, we'd expect to hold up well, even generate a positive return. The other two pieces are a little bit more dynamic. So they might not hold up quite as well, but we wouldn't expect them to return anything like equity markets would, if the equity markets were off 20%. So in theory, if we had to raise money in that period, we could easily take it from the fixed income portion of the portfolio. Probably if you were raising $1 million when the equity market was down 20% from a rebalancing scenario, it would tell you to take it from fixed income entirely anyway. So, we could probably provide $4 to $5 million of very conservative fixed income allocation in the long-term pool that if you had to kind of raise all of it very quickly and we were concerned about hitting depleted equity markets, we could facilitate that without too much worry. So there is still some protection in the long-term pool, right? It's not like it's an all equity bucket. There's some levers there we can pull to provide liquidity even in tough, choppy markets.
Thanks for that, Mike. John, can you just also remind everyone what our TD Bank balance would be compared to where it normally would be, just to sort of take an expanded look at short-term?
Certainly. Yep. So, usually at the end of, once we get into the summer months, we're usually running very low on cash. What the projection is currently calling for is approximately $3 million, in the June, going into July timeframe. So we're a little bit healthier than we have been historically. So that is something that we can kind of keep in the back of our mind as well. Should we have any short-term needs, we should have some cash at TD Bank as well.
Thanks for that. So Mike, curious your thoughts on the slide here, right? So dollar cost average $1 million into long term through May, and then slowly bleed that back into short term at a much slower pace. Curious your thoughts on that approach.
Yeah, I think it works. I think, this is a good initial display of what the process could look like. Because there's so much uncertainty, I think probably the end game looks quite a bit different than this, maybe not, but once you get an actual timeline for the building, how much the state hopefully will fund, all that stuff, whatever's going on in the world at that point, we can definitely, it's not like we have to commit to this and this is, said and done. We can adjust pretty quickly because everything is very, very liquid. So I think kind of staying on par with this, even in this scenario, if you had 5 million here, you still had $6 million in the bond portfolio of the long-term pool. You needed to raise all that money all at once, and the equity markets were off 20%. In theory, that's still $11 million we could get, access to pretty easily that potentially accommodates both any operating shortfall and the $6 million pledge to the building. So I think this is a good starting point, but one that probably we keep a close eye on and to determine how quickly we kind of revert the money back into the pool. I don't love the fact, Mac, I know we touched on this last time, just given where the world sits today, COVID, valuations, rates, geopolitical events, kind of everything that's going on, kind of just accelerating that. I don't love. I like kind of keeping us on a structured pace here of gradually risking up some of that free capital, and then hopefully taking the gains off the table as it comes closer to writing that check for $6 million.
Yeah, I appreciate that.
My only last comment is that we could certainly keep sharpening the pencil. John and Andrea working offline with Mike on some of the modeling for this. I think, Mac, for us, the biggest risk always in our forecasting is the enrollment piece. And, where do we project next May, June, really April, May, June, right? And how we land with that in our budget forecast and what that means to the sort of cash position and that sort of approach here. So, I appreciate John and Andrea having this ready to go and giving us food for thought. That's that, Mike. That's that big bogey for us, though, is the enrollment forecast piece. Again, that is our bear market that we've been living for, in some ways, 10 straight years, likely an 11th. So obviously, we'll be talking much more about that.
Okay. Yeah, I echo that. Jonathan and Andrea, thanks for pulling this together. Nice, easy display for us to kind of ponder. Interesting to watch the look at the bottom. The bleed back into short term. I know that's something that we've not really like talking about moving back. We put it there and keep it there is kind of what we talked about in the past. But given the circumstances, it makes sense.
I guess just to ask one specific question. So our current schedule has us moving $1 million through December. Is that right, John? So the last one is December. And so this committee meets again at the very beginning of February. Do we want to move that January million as is here and then pick this up again in February? Or do we want to hold off and just do the million in December? Or should we move the January? Should we move $1 million in January and then talk about what to do next in February?
Yeah, it's a great question. I'm comfortable moving the $1 million. I don't think that's gonna cause us any issues. So I'm comfortable with that move. That's a great point, Andrea.
Great, thank you.
Do we need a motion for that? Or we can just do it as part of our normal course of business?
Yeah, I think we can do it as part of the normal course of business. Our investment policy statement has our portfolio structure strategy embedded. And it basically the main talking point that we would want to focus on is that we don't exceed our unrestricted net position as part of the long-term portfolio. We'll be well under that. So no motion would be required.
Excellent. Okay. Yeah, let's move forward then. Okay.
Great.
Anything else, Mike Chase, you wanted to review with us?
That's everything I had tonight, Mac.
Okay, great.
Any other questions?
Nope. But as always, excellent job. Appreciate the walkthrough. Any other business we want to go through? Okay, great. I guess with that, we'll adjourn the meeting. So moved.
Good night, everyone.
Thank you, Matt. Thank you,
Good
Mike.
night.